We start off with the airlines going up, up, and away today as Delta raises its first quarter earnings guidance, lifting the entire space along with it. The airlines and transports taking off in just the past week. So is this group signaling the all clear for the broader markets? Guy Adami.
Hi, Melms. Well, I don't know if it's signaling the all clear for the broader markets, but it's signaling the all clear for the airlines now, truth be told. And congrats to Tim and Karen. They've been on this. We talked about this now for the last few weeks. We specifically talked about it when the Boeing news was at its worst on a day when the airlines were all up anywhere from 2.5% to 4%. We said that's a great tell. We actually mentioned Southwest Air, but we talked about Delta in terms of valuation. And now these things are starting to come to fruition. You'll say, well, have they run too far too fast? I would say no. I still think there's significant room to the upside. And the point of Delta, I mean, there's no reason why we can't see it back to the highs we made a few months ago, which I think is around $60 or so. So I do think there's further room, but I don't think it's making a statement as to what the broader market can do.
So for Delta, first of all, I appreciate the compliment, Guy, but I have to say that Delta, it's not like it's been the greatest trade in the world over the last 6 months. And so, in fact, you could look at the airlines and say over the last 5 years, or certainly 4.5 since they re-rated from those awful levels to a place where people think they're running their businesses differently, that it's been a sideways trade and there haven't been absolute returns. There's been enormous opportunities to trade and make money. And I think at the bottom of the range, Delta, which is now only 5% off the bottom of the range, I think there's an enormous opportunity. Their customary first quarter update. So what did they tell you? They told you revenue for available seat miles is going to be up about 1%, and that's against available seat miles growth of about 5%. So basically, this is very positive. It's growing faster than the cost side of the business, which is good. They've redone their deal with Delta, with American Express. They are Delta, and that's a very top-line accretive and probably even bottom-line accretive deal for them. And I think people are very relieved to hear that. So this is great news. And again, this is a customary update where I think people tend to get too negative on airlines, and that's where they were.
Is there a true extrapolation to the rest of the sector, or is this Delta specific?
I hope that it's not just Delta specific. I mean, I think they're a great operating team, so it could be just them. But I think for cost, that should hopefully bode well. We'll have United Airlines later in the month and American Airlines, I think, April 25th. Hopefully for them, and it's good news, too. I think the American Express portion is obviously specific to Delta. But even with this move here, which is a really big move for Delta, the stock is not expensive. I know they're obviously cyclical businesses, so they shouldn't get anywhere near market multiple. But, you know, at this price, I think there's more upside. I would not be inclined to be a seller today.
You know, interestingly, you asked about the broader market. You know, obviously there's those Dow theorists, right? And we could look at the IYT, that's the ETF that tracks the Dow Transportation ETF, and it really has been an underperformer. Obviously, the airlines have lagged. There's been the rails have done pretty well. We know that FedEx and UPS have not. You know, there's been a lot of rotation of late. The IYT just rallied from, I think, about 180 to 190 in a straight line over the last week and a half. Interestingly enough, closed down today. We have a one-year chart. It also actually broke above a downtrend that's been in place from the highs earlier in the year. This would be something that if it was able to kind of get through, we were able to see some of the other names act pretty well, you may have some room to the upside. That being said, if it were to fail right here, there'd be a pretty nasty failure, especially on some fundamental news. I just mentioned that obviously Delta opened up and got better throughout the day, and I think that's actually very good. United didn't trade so well. American didn't trade so well. Southwest didn't trade so well. And it brings me back to last week. Remember when we had good news out of some of the home builders? Lennar gapped up to multi-month highs, that sort of thing. Gave it all back a couple of days. Delta didn't give me any sense for that today, but that would be something to keep an eye on over the course of the week.
Well, the thing that happened today as well is WTI and Brent hitting their 2019 highs. Yeah. And so you got to wonder at what point, if there is a point in which fuel costs actually hurt the airlines at this, you know, at $62 on WTI.
But they gave some insight into that, and they basically, you know, it looks like it's effectively neutral, and some of it's offset even by some FX. So I think if you look at the transports, it's a good point. I mean, ultimately, you know, you've had certain parts of the IYT or certain parts of the sector that have done very well. The airlines, frankly, have lagged. And then FedEx, the last two times they've given us updates, not so good. Yeah.
Right,
and I think that's really holding it down.
The stock is above where it was FedEx when they announced that miss.
The last miss, as opposed to the last miss.
Right, as opposed to two misses ago, was, you know, 181 or so, and then they announced a miss, it went down to 175, so it's well above that now. So I still think FedEx is great here. So
me too.
Yeah, that to me is more telling of the market than the airlines.
The economy, you mean?
Yes, FedEx. Yes. I think of it as a closer proxy to the economy than the airlines.
Well, it's interesting because FedEx probably topped out a year and a half ago, and you know the stock's down until recently 34 or so % from its all-time high, where the stock market, in terms of the S&P, is only 4% off its all-time high. So I'm not. Maybe FedEx is just losing the battle to maybe FedEx just out FedEx himself. Maybe Amazon is catching up, and maybe their world, maybe they're just not a barometer for the economy like they were 2 years ago. I think you better hope that's the case.
Well, they
because
still
if they are
TNT.
barometer,
Their
then we
acquisition
have
was
problems.
terrible. It's really
The cyber attack, it really hit them very hard.
right. They had some management
costs.
changes. TNT's been bad.
I feel like, Dad, this might be a UPS guy talking about
Yes,
Facebook.
I think you're
So-
talking
I worked
around.
at UPS, and I'm yes, I had a great day.
Very
there. I
loyal.
wore shorts, and I'm sure at some point today we'll get the footage of it. Or
I
we'll
hope
put
not.
It, pardon me?
I mean, you can't unsee certain things, so we might save the viewers some pain. And
Fortunately, I'll just go back to my Twitter feed. And
so, what
post it.
is a good read on the economy, if not the transports as a whole? What should replace
can I add
that
something
Dow
that
theory?
Okay. I thought the way the banks acted to the better data, I'm just saying, it was phenomenal. I mean, when
Yes,
you look
it
at
was.
when you look at JP Morgan, they acted so bad when we were in like recession like alarm territory
there
a
a
couple
but
weeks
coming?
ago. No. But JP Morgan went back from 98, 98 to like 105, like that, with just 2 days of saying, okay, and Tim's been saying this, that maybe the data in Asia is bottoming out, and that will kind of find its way into emerging markets, and then maybe we were never so bad here. We were never on the brink of a recession. That's how the bank should act, if that is the kind of underlying thought here. And they did. Now, they've not made back all the losses over the last few weeks, but it was a really sharp snapback, is what I'm saying.
And I appreciate that kind of reflective look upon banks. That's thoughtful, and it always is, out of Dan. But I think if you look at the yield curve, you actually had this case where the 5-year part of the curve, folks, if there's a little trade school, I mean, this is typically the belly of the curve is where you get really the most assumptions on growth, and the 5-year was the part that became so overbought. And then you went basically from 211 up to 232 or something like that back. So in other words, it took a lot of it back. I think bonds were just overbought. Yields were overly low, and I don't think it was reminiscent of what was going on.
I think the market also just flips out on the yield curve as it relates to banks, even though that's really not their business. They're not in a giant yield curve trade. And the net interest margin, that's only half of their business, right? So the perception was that they're not going to make any money, right? The margin's going to go to zero, and the economy's terrible. And, I mean, it was absurd. And it's not like they're trading at a giant growth multiple in the first place.
Unless people are perceiving the yield curve as a read on economic growth. In which case, maybe that correlation.
But that's exactly that's why I brought them up. I mean, so to me, the underperformance for a better part of the last couple months, relative to a market that's just ripping, they really had been going sideways, and a lot of that is because the underlying fears of slowing global growth and the heightened chance of a recession here in the U.S. And they acted appropriately in the last week when you have some of those fears allayed a little bit.
But if I had to play you, I would actually say I would be disappointed that but the banks weren't rallying when rates that much when rates were at 3.25, and you have to acknowledge the trend on rates is lower. It's not higher. And if that's the environment that's the indictment of the economy, so be it.